The first rates on your screen, there you go. 39 points higher for the Nifty and 900 and about I just let the screen do the talking here because there's no clear trends which clearly are there. 127 points higher for the Sensex, 2 points here or there on the Bank Nifty. The breadth of the market is looking meaningfully better than what it has looked in a long time. Let's look at some individual stocks. Now you want to start with autos because that's one pocket where you have mild outperformance. Mahindra & Mahindra, Tata Motors and to some extent Bajaj Auto. Leyland also has done rather well for itself. Siemens, ABB, that Cummins, that space has done rather well for itself. There was a dead cat bounce in some of the insurance stocks yesterday, so it included Star, ICICI Prudential, HDFC Life. Can those stocks come out of the COVID sell-off what they saw? But nothing in the system which is looking extremely exciting. I mean, Zomato was a big mover in the second half of trade yesterday. Let's look at Zomato and Policy Bazaar, but that's about it. Yeah, this is the only one which is showing signs of life and inertia. But barring that, nothing, honestly, nothing.
Mahindra Bank, that's the one in focus. Reports are indicating that the company is likely to have tapped on Egon Zehnder for their CEO search. Interglobe Aviation as well. Air travel has managed to set a new record high in the month of February. The average daily passengers has now hit 4.20 lakhs. ACC Ambuja too, because there's positive news flow, and I think this came in yesterday post-market hours, wherein they've resumed operation at their Himachal plants. The freight rates have been lowered by 10 to 12%. Both Ambuja and ACC have gotten off to a good start there. BEL as well, they've launched indigenously developed signaling system with Delhi Metro. The first rates on BEL haven't trickled in. And then, of course, there's Tata Power, Adani Power, IEX. They're all in focus. The government, remember, has mandated ICB power plants to operate at full capacity. So that's positive news flow for both Tata Power as well as the Adani Power and IEX, wherein the Power Minister has mandated ICB power plants to sell surplus power to power exchanges. So IEX as well, this augurs well for that. Minda Corp and Precall, the clarification coming in, wherein Minda has reiterated in that conference call that held yesterday that it will remain a minority shareholder in Precall and that they are not looking at a hostile takeover by any chance. So that's one stock which is also in focus. There's BEML as well. They've signed an MOU with DMRC-led SPV for a Bahrain metro rail project in the phase 1. So that's another stock which is in focus. And then, of course, there's Bharti as well, which has now rolled out higher minimum recharge plan in 2 more circles. So that's another stock which is in focus. But again, it's just really tempered all across. You're not seeing any big moves anywhere. I just want to revisit some of the big movers from yesterday though. Shree Cement, Coforge, Persistent Systems, and then Samvardhana Motherson, which held out by 3% yesterday. Let's see where that is currently standing. Midcap IT actually continues to see a very smart follow through. Both Coforge and Persistent are winners today as well. But Nooresh, at an index level, there's nothing happening. Absolutely flat a start.
Absolutely a flat start, so nothing much to make out of the index, but the fact is at least we have not taken a sharp tick. And the small cap index also remains flat. So IT is a pack which has been doing well, and that is where I like Wipro, because that is a stock which has the best risk reward as of now for a bounce back trade. So Wipro at 407 is what I'm buying in today.
Okay, and Kunal's first trade, that is a buy recommendation on Tata Motors.
Seshadri Singh joins us now. Let's take a conversation forward as to where he feels markets are headed and how things what really will be the factor which will take this market out of the range. Seshadri, good morning. Thank you for joining us. A lot of assumptions are getting challenged. 1st of Jan, the general view was that this will be a comeback year for demand. This will be a decent year for commodity consumers, and banks, they will continue to charge ahead. But now there is a slowdown. Global macros are deteriorating and NIMs are coming under pressure. Have the assumptions is the reset button has been pressed?
Certainly some of the assumptions are getting challenged. Let's start with bank NIMs. With the way deposit rates are going up, we saw that banks reported fairly strong NIMs, and they may report another quarter of strong NIMs given that the RBI may hike further. But the markets are looking ahead and seeing the deposit rate hikes and know that this is not sustainable. And from the latest, the first quarter of next financial year, you're going to see some of the froth go off the NIMs. And therefore, you've seen a lot of the bank stocks not perform. We think within the banking sector, you have to look at the quality names and deposit franchises which have been ignored for the last 2 odd years will come back into fashion this year. Strong deposit franchises will get rewarded this year, which has not exactly been the case last year, right? When
Last year
strong
we saw that also.
businesses,
PSU banks are ultimately strong deposit franchise.
yeah, I mean,
they did
we're
very
seeing
well.
within the private space, at least the strong deposit franchises were underperformers.
With the exception of one name.
Yeah, I mean, one or two, one or two, or even three, were relative underperformers last year. So I think deposit franchises will get rewarded. The PSUs have re-rated, but that's part of a different cycle, and from here on, risk reward is probably not as attractive as it was last year. As far as demand is concerned, certainly there is a base effect coming into demand. At least discretionary demand in the third quarter has raised some red flags. I'm not sure that's a long-term phenomenon, at least in India. I think the demand will start to come back. There was some front-ending in the festival season, I suspect, which had caused this. And I expect demand will remain fairly strong through this year. One source of worry on demand is that bottom of the pyramid demand remains weak and has been weak since COVID. We are all expecting that at some stage, given that incomes at the bottom of the pyramid have come back after opening up, that will start to rebound. Inflation is a worry, and probably you're right that inflation may remain higher for longer than everybody anticipated. But that's one factor that we need to keep an eye out on, not just from a markets perspective, but from a macro perspective, because we can't keep growing as an economy if bottom of the pyramid demand remains this weak.
Sure. So staples, PSBs, what else are your overweights and underweights?
We like three sectors. Manufacturing is something that we continue to keep an eye out on, because that's part of a global trend, that's part of a long-term trend. The budget is a great supporter of manufacturing. So the entire manufacturing space is something that we continue to like. The second is information technology. We think that sector was brutally derated last year for the right reasons. It was overvalued going into 2022, and there are obviously concerns about growth given what's happening with US interest rates. What we are now discovering is that growth may not be as bad as everybody thought it would, and that's something that is gradually becoming visible as more and more earnings and management commentaries come through. Second, of course, is that margins should start to come back, because there was a lot of subcontracting, there was a lot of wage inflation that is easing up, and therefore margin outlook is improving. And the third is that the egregious overvaluation is now gone, right? It was derated, and the valuation. So at the beginning of the year, we were a little more constructive on information technology than we were at last year, and that has already started to play out. And I think this will be a good year for information technology. So
are you selective, or is that a blanket call on IT? I mean, is it mid-cap IT versus the large caps, or it's the top tier large caps versus mid-caps?
I think one truth about this year is that you have to be selective everywhere,
That's
right?
true.
Because it's not just that the fundamentals have to be strong, but you have to keep an eye out on valuations. I don't think we are in a zone of the market where you can afford to buy stocks at any valuation that you think, and that will give you returns. So I wouldn't bucket it in terms of mid cap,
Sure.
etc. I would just go stock by stock, look at the fundamentals, and look at valuations in the context of those fundamentals, and pick stocks that way. And yes, there is some of the mid-tier names which have been absolutely battered are starting to look attractive. But it's not a blanket call for sure.
Sure.
And even within manufacturing, that's a broad spectrum. You're saying you're likely to see quality making a comeback. So where within manufacturing are you seeing the potential?
Yeah, you're right. It's a broad brush stroke. So the areas that we are looking at are capital goods, auto ancillaries, even areas like chemicals, etc., right, which have underperformed last year. All these sectors, and some pockets of pharma as well, right, which also come into. So this is the broad brush of where we are looking at in manufacturing. Again, the same thing that I said about IT. you have to go stock by stock, because some of these, especially say if you look at capital goods, some of the stocks are really expensive. For B2B businesses, you can't be paying those valuations and hope to make money. So certainly, the sector is doing well. The fundamentals are in great shape, but you've got to go stock by stock and look at the at where the valuations are, where the fundamentals are, and one overarching theme for this year is that quality will make a comeback. You have to be sure about managements, about balance sheets, about cash flows. That was given the go-by in 2022. Anything and everything was rallying. But I think in 2023, you've got to go back to those basics and look at those, because otherwise you could get very badly hurt.
So back to Asian Paints, Nestle, back to...
I said you have to keep an eye on valuations. So you can't buy stocks at really high valuations and hope to make money.
So aren't capital goods expensive? We were looking at some data, I think last week, that most of the capital goods stocks, ABB, Siemens, I'm just giving that as an example, are trading at P multiples of 50 plus, 1.5, 2 year forward. Growth is anywhere between 15 to 20% because of the base effect. So some would argue and say that capital goods order books will grow, but after the recent run-ups, these stocks are almost trading at P multiples that consumer companies are demanding.
Yeah, meaning the MNCs have been valued at those multiples for quite some time. So the market is seeing something there. But a lot of capital goods is a very large sector with lots of small companies, and a lot of those are not valued at those very high multiples. I'm not saying that the MNCs will get derated, because there's no trigger for their derating, and there's a reason why, because they have the technology, right? So the others are, usually are just manufacturers. They have the technology and the market rewards them for that. But in general, apart from some special MNC companies, you would have to keep an eye out on valuations when you buy capital goods.
So what, in the schemes which you manage, multi-cap, large cap, mid-cap, what has changed between 1st of Jan and now, given that the view on the market and economy has changed? Have your top 5 holdings changed?
Yes, to some extent it has changed. Broadly, we've done 3 things. One, we've taken a harder look at our financials exposure and are trimming some of the names. 2 is that we are trying to increase our exposure to manufacturing, but given that we are a little mindful of valuations, that is proving to be challenging. And 3 is that we are steadily increasing our exposure to IT.
That's a very contra call, right? I mean, it's completely against what the street consensus is.
Which IT?
Buy into IT and start trimming banks.
Well, we haven't, truth to tell, we haven't trimmed. We're just re-looking at some of our exposure, shuffling some of our exposure. We have trimmed a little bit, but not a lot. IT, we are very constructive about.
But in your PMS, I'm just looking at the banking names. There's Axis, there's HDFC Bank, there's ICICI Bank, there's of course Federal as well. Your view is more staunch when it comes to PSBs. So I'm wondering whether you're trimming this list.
We very frankly hadn't invested much in PSBs.
Okay.
Very frankly, we hadn't invested much in PSBs. Very little. We as a house, we rarely invest in PSUs. And therefore, there's nothing to trim.
Sure.
There's nothing to trim there.
Wanted to get in your take, of course, on the Adani group of stocks. What's been the view?
We haven't invested in the Adani group because we stay away from leverage companies. So that's part of our process that we stay away from.
From a market standpoint, the collateral damage what we saw in lenders, the domino effect what we saw in other sectors, that there's a problem with a large corporate group and it could have a ripple effect on other sectors and other parts of the economy. Do you think that fear has subsided, or that's a genuine fear which will haunt us?
I think that fear has largely subsided. That fear has largely subsided, and kudos to the banks. They've come out. All the large banks have come out and disclosed their numbers, and everybody's discovered that the numbers aren't very large. It's not like the early 2010s where it's a number of groups which are stressed, which are potentially stressed. Maybe even with Adani, we don't know. So I think that fear has largely subsided.
I'm just looking at the market right now. You've got autos which are doing rather well. We've got hotels which are doing rather well. Airlines are doing rather well. If I look at the economy, it amazes me. Expensive watches are being sold. Expensive cars are being sold. 5-star room rates like never before. SUVs are being sold more. What is this telling you about the economy?
It reconfirms our view. We are very, very constructive about the economy for the next 3-4 years. And we think that India is coming to the point where with every year your per capita income is going a step up, and we've seen history, right, from $1,000 to $1,500. That journey drives a lot of top end consumption, right?
The rich are getting richer. That's the bottom line, I think.
Not just the rich, it's the middle class move,
Also,
transitioning up. Metro consumption, if you ask some of these companies which have reported weak demand and you ask them to drill down, they'll tell you that metro consumption is fairly strong. It's tier 2, tier 3, which is quite weak. So it reconfirms our long-term view on the economy that we are in for a multi-year journey where as we progress from $1,000 plus and over time progress to $1,500 per capita income, consumption will open up. The bottom of the pyramid, as I said, does worry us, but we think it's a matter of time. It's the inflationary impact will subside. The worst during COVID, where there was a lot of loss of income at that level, that will start, has already eased up.
And you'll have election spending as well.
To some extent, that will also happen. If the government is able to execute this capex plan, there'll be a lot of construction work. Those are typically high employment sectors.
Yeah.
We are seeing some signs of the textile sector. The reports that orders from Tirupur are starting to go up. That will also impact. Textile is another huge employer all over the. As trade opens up, next year, that will also impact SME employment. So we are quite, we don't know when, but over the next 2 years, we think bottom of the pyramid consumption will also come back. It's just, short-term factors which are.
And
Go ahead.
defense also finds favor, right, as a sector?
Yes, defense does, but again, stock by stock valuations have to be kept. And defense you have to hold for long periods. It's because it's very lumpy, and if you buy a defense stock and track it quarterly, and it's going to lead to a lot of heartburn. So you have to look at the long game.
I'm going to play out a promo of a new show, and you're going to watch this show. It's called Class of 21. Companies which have gone public in last 18 months. PB Fintech, Zomato. My question is that some of these companies have realized that the rules of the arena are different, which is that you were in a private arena, you've come in a public arena. The rules are different, the guard is different, the referee is different, and the spectators are different. If that is the underlying understanding and realization for some of these companies, are you now looking at these high growth businesses where managements have changed their heart? Like they say in Hindi, subah ka bula shaam ko aata hai to bula nahi kehte. They've come back and realized that the arena has changed.
Short answer is yes, we are looking at that.
Did you buy them after?
We bought a couple of them after correction.
Did you participate in the anchor selling block deals which were there?
Not really, no. But we have looked at a couple of them for 3 reasons. One is that we think these are businesses which are building long-term value, for sure. Meaning if you are if you believe in the Indian digital story, right, which we do, we think that the digital story in India is strong. These are the players who will own that digital story, right? Meaning if you want to order food, there are only 2 companies you can order from. If you want to use, if you want to pay, you use a UPI. There are only 3 companies that you use a UPI. So there is value. Secondly, some of them, as you just said, once they've listed, they realize that the game is different, and they've learned their lessons, and they're focusing on profitability, right? And the funding winter has also aided that, and some of them are starting to deliver on that profitability. And the third is that the more egregious overvaluation that was there at the time of listing has now gone. So yes, we are looking at them. But they probably will be a little bit of a long ride. It's not because once so much price damage has been done and so much perception damage is done, it is usually a longish kind of road to emancipation. That's a bad word, but to redemption in the eyes of investors. Sure. But we are certainly selectively looking at them.
Okay. Thanks so much for taking the time out and joining me in the
Thank you for hosting me.
Thank you. And good to get in your views. Let me just revisit the markets, and before we move on board and welcome our next guest, that's Vinay Sharma, Fund Manager at Nippon India Mutual Fund. To talk in specific about banks, there's been a lot of chatter around which way the banks are going to head, who's going to lead the race, whether PSBs was just a fad of last year. Let's try and analyze all of that. But before that, for the market, it's really a no-go day. We're up just about 29 points in the Nifty futures. 17,892 is where we're currently at. Aditya Birla Fashions is the one which is currently down. It's down about 3%. Adani Enterprises continues to bleed, down another 2% today as well. BOB, AB Capital, IDFC First is the financials which are weighing heavy on the indexes today. On the flip side, cement continues a buzz. So Ambuja holding up another 3.25%. JK Cement is up 1.6%. IGL is looking good. Lalpat Labs has made a comeback, and NMDC is the other one, Nikunj, which is actually holding up 2.6%. But banks are not.
Yeah, banks are not. And is the best of the banking NIMs, that's net interest margins, that's behind us. Will the base effect kick in? Markets have been applauding banking stocks for a while now, but is there now time to get cautious, or it is time now to change the view from optimistic to cautiously optimistic? Vinay Sharma joins us, fund manager with Nippon India Mutual Fund. He understands the banking sector. He's got a very deep understanding of cycles and what is in store for the sector per se. Vinay, good morning. Thank you for joining us.
Good morning, Egan. Thanks for having me here.
When we walked into the show this morning, there's a comment from Uday Kotak, which is that the NIMs for banks have peaked out. Then we had one of your peers from Alchemy. He also seems to be endorsing the same. Do you think this exceptionally strong, high margin, high growth for banks now is over?
So we would say, Nikunj, that at some point of time, this would always happen, right? The base effect would kick in, and the pace of margin expansion was not sustainable because it hurts other industry segments if banking margins remain so high. Plus, deposit growth is lacking credit growth for quite some time, and loan repricing happens faster than deposit repricing, as we all know. So therefore, all these cyclical things put together, banking margins now I think would find a base. But the bigger question to our mind is whether banking earnings will disappoint anytime soon, or is the asset quality reversing at any point of time? Do we need to get cautious on the credit cycle or credit growth? To us, the answer is still a no. We still believe we are in a good shape when it comes to credit cycle, and there are no big asset quality issues that we can imagine at this point of time in any of the large segments, whether it's household, whether it's corporate, whether it's SME, MSME. So while it is true that margins have sort of peaked, and maybe in a quarter or two you would see you expect some sort of decline in banking margins, but we still continue to believe that banking earnings will be a strong driver of Indian corporate profits in FY24 and FY25. And unless global growth surprises us really negatively, this view sustains.
Vinay, morning. Is there a worry that, yes, we may see strong earnings momentum sustain in the final quarter of the fiscal year, but once we see interest rates starting to rise, that could be a major drag on credit growth for some of these banks?
So again, the answer remains the same. As I said, that there would be some base effect that would play out, and credit growth would probably cool down from the high teens to maybe mid-teens. But we still expect banking earnings and credit growth to sort of in these mid-teen sort of range for another 1 or 2 years. As I said, we still believe that there are several legs to credit growth. Retail has been doing well for some time. Corporate credit growth has picked up. We are seeing short signs of private capex picking up, and manufacturing is sort of here to stay for some time to come. So all these put together, we believe mid-teens credit growth is possible for the next at least 1 or 2 years. And earnings growth would probably be in line with the balance sheet expansion now, because we have seen the best of margins as well as the credit cost decline that banking system has seen over the last few years.
Is the best for PSBs though, Vinay, behind us?
Sorry, I didn't get your question.
PSU banks is the best behind us now, and I'm not talking about SBI. I'm talking about the the smaller ones.
Again, we have always been selective on PSU banks, and we have preferred large banks over the mid-sized banks. But on an aggregate basis, if you look at PSU banking space, we believe it's in good shape for some time to come, because one, uh, the deposit franchise of PSU banks still is very strong, and given the scenario that we are talking about, where deposit franchise actually plays a very important role in determining margins and earnings of banking sector over the next few quarters, we believe this deposit strength will play out over the next few quarters. And therefore, PSU banks are in a decent shape, given that we are still sanguine about credit quality and we do not expect credit quality to show any signs of stress. PSU banks generally tend to sort of underperform, or be relatively underperform when the credit quality starts turning around. That is not a view that we have at this point of time.
Uh, when we are looking at slowdown which has kicked in post-festival season, small ticket categories, rural demand is still anemic. But if I look at the retail growth is absolutely gangbusters. So one side we are looking at slowdown, second side we are looking at the retail growth. It's not adding up.
That is correct, Nikunj. I think we have seen this K-shaped recovery that we keep talking about, where the middle class, upper middle class, and the high income segment of India keeps doing well, whereas the bottom of the pyramid has not really come back to its normal strength as of now. We believe some of these again should start normalizing, especially with this election spending and all those talks that you are doing with your previous person on the channel. Some of these would normalize, but yeah, that is the reality, that India is going through a sort of K-shaped recovery, where the upper middle class and the high income segment is doing quite well, whereas the rural incomes have not revived to their full extent.
Okay. Uh, so one looks at the assumption that 15 to 18% credit growth is here to stay. Would you say that that is something we should also expect from the stocks also? It's not going to be a P re-rating or a price to book re-rating. It's going to be simple earnings growth, whether it is 10, 12 or 13, depends on the growth.
I would say, given the recent correction and the FII outflows that we have seen over past few months, some of private banking names and some of the large PSU banks have again become reasonable in valuations, and there is scope for some re-rating as and when this belief comes back that we are in the middle of a benign credit cycle and there are no credit issues at this point of time, and earnings will remain strong. So we believe that there is some potential of re-rating possible in banking sector. And if you look at 10-year averages or 5-year averages, 5-year has been is sorry, a bad period because India went through that NPL crisis. But if you look at 10-year averages and generally the ROE potential of these banks and the fundamentals in terms of growth and returns, we believe there is some scope of re-rating. So I would say before this correction, what you said would be exactly what I would echo as my opinion as well. But given the correction that we have seen over past few months, valuations have become reasonable again.
Okay. Let's wrap it up with one final question, and that's a completely macro question. What if inflation remains high? And what if after a 25 bips rate hike, we may end up with another 50 bips rate hike? What happens to banks in that kind of a scenario when the macro, which everybody is assuming would be inflation will peak out and interest rates will peak out, if that thesis, let's say, gets challenged in next 3 months or 6 months?
So yeah, if we are talking about risk, I think there are two big risks to both Indian macroeconomy as well as banking sector, because banking sector finally is a reflection of macroeconomy in a larger sense. So we think the two bigger risks to markets, banking sector, economy, all of that. One is a global slowdown. And that's the primary one. If global slowdown is far deeper than what we expect at this point of time, if US really had to put brakes on his has to put brakes on growth and go through a slowdown phase for more than 2-3 quarters, that could be detrimental to our growth, some of the export-related sectors, and general flows, capital flows, all of that, and obviously that would be detrimental to market valuations and banking sector valuations. The other is what you said. If inflation remains high, even in India, and we have to raise interest rates to that extent where it starts hurting corporate loan growth or housing loan growth or general economy, if liquidity is tight and all of that. If that scenario happens, obviously we'll have to revisit our assumptions. But as of now, the assumptions that we have taken is global slowdown would be benign and it would not be very harsh. And second, Indian rate cycle peaks out somewhere when US interest rate cycle peaks out, it's somewhere around that time Indian interest rate cycle and Indian inflation also peaks out. So these are the broad assumptions behind what we have been talking about, that global slowdown would be benign and inflation would come under control. But if that doesn't happen, yeah, then there could be risks to macroeconomy as well as market valuations.
Okay, Vinay, great to have you on the show. Thank you so much for taking the time out and joining in today. Let's just revisit the market. We're completely flat. Ambuja Cement holding up 3%. NMDC looking good by another 3%. IGL, Lalpat Labs, Emphasis, these are all big winners in trade. Of course, the positive news flow on Ambuja and ACC both is that they've got to resume their operations in Himachal plants, and the freight rates have been lowered now by 10 to 12%, and this augurs very well for both. We'll take a very quick break, but don't go anywhere. We've got a very special interaction with none other than N.R. Narayanamurthy on the other side of this break. Absolutely flat today, at least for the index. Of course, there are individual stocks which are moving here and there, but nothing really in terms of a trend that you can pinpoint for the markets. So let's get in a wise word then from none other than Ramesh Damani, sharing his advice on how to invest for the long term, especially for the youth. Let's hear out his strategy.
We can invest small sums of money for the grandchildren on their birthdays, and we just leave it unchanged for the next 10, 20 years, at least till they reach college age. And, they'll have a legacy, if I'm right, that the grandfather did something for them and the grandmother did something for them. So the first point I would like to mention, because this is a great idea, because you look back at the last 30 years, people who invested very small sums in India, at 1,000 level of the index or 1,500 level of the index, or even at 4,500 of the index, the March 92 when it topped out in the 92 bull run, still have made out like bandits over the years. Some have made 50x, some have made 75x. In the last 30 years, you could have done any number of things, but you remained invested in equity, you actually became rich. So with the belief that the past is going to be prologue and what happened in the past will continue happening in the future, that the Indian market remains to be excited, I think it's a good idea to, I would strongly think it's a great idea to invest for your grandchildren. Now, what do you invest? I mean, if you're someone who has no time to follow individual stocks, it's very simple. Buy an index tracking fund. When the market corrects, buy a fund that tracks the Sensex and Nifty. Keep it for 30 years. If the Sensex doubled, you double the money. If the Sensex goes to 5x, as it has in the last, say, 10, 15 years, you'll make 5x your money. So it's a great thing to do that. Person like me who's more interested in capital allocation, more interested in finding stocks, we try and find stocks that are gleam in the eyes, small caps that can become mid caps, or perhaps even large caps over the next 10, 20 years or so. Unfortunately, the SEBI regulations, I can't discuss names with you, Nikunj, but I would suffice you to say that I have been doing it, and I'm finding things that I want to hold for 10, 20 years, and hopefully they'll be right, and they will be a mother lode of value for my grandchildren at the end of the rainbow.
But when you're investing for your grandchildren, Mr. Damani, I'm sure you are more than companies, you are betting on themes, because that's what investors can do. You cannot specify 20 years down the line which company will make it big, but you can certainly specify that that area in which you are investing in, that area or that business or that sector could become big. So can you throw more light on that?
Yeah, I mean, we bought, to give you examples, some consumer companies. There are, just without giving names, there are watch companies that are trading at, not the Titans, but the other ones are trading at, fairly, reasonable valuations, which seem prospects look good. There are, fintech companies. Finance is going to be a very important part of everyone's life and continue to be, particularly in the right answer. I don't think Bitcoin is going to take over the rupee at any time in the next 40, 50 years. At least I don't think so. So, some of the leading fintech companies are, good places to park your money.
Okay, let's address another piece of earnings, and Dishman Pharma has come out with its numbers. Let's welcome on board the Group CMD, Janmejaya Rajnikant Vyas, joining in on the show right now. Excuse me. Mr. Vyas, good morning. Great to have you today on ET Now, and I'm just going by your Q3 numbers. Dishman, we get a sense that, the journey of affecting a gradual recovery across segments, especially the India business, is quite visible. Explain a little bit about, what kind of recovery are you seeing in India and whether these numbers look sustainable and strong in the long term as well.
Ma'am, yes, they are sustainable and long, and it is in the view of our strategy that we will be bullish.
Hi, morning. Now, given that we have seen your India business recovering, a lot of the issues have been resolved. Can you talk to us about, the clearances from your customers, the restart that have helped in the restarting of the production facility, and more important, what is the outlook on your India business?
Yeah, basically, I cannot talk about the India business, but overall the business is very good, particularly in Europe and Japan.
Okay. One of the top brokerages, Mr. Vyas, is saying that triggered EDQM inspection for your Bavla facility and expectation completion and approval is going to come in by the first quarter of FY24, which is clearly a key trigger for your company. Help us understand a little bit about this.
Yeah, basically it is, I have to see the what is the figure, and then I can talk about it.
Can the India business post all approvals see strong revenue and margins uptick? Because you've guided for a 25% revenue growth. How is it that you plan to achieve that, and are you confident about the same?
Basically, it is growth that we expect from the plant which is closed on regulatory closure, and we are now trying to
Sir, thank you for taking time out and joining in, giving us a quick glimpse of how business at Tishman Carbogen is shaping up. I just want to take a quick look at the markets, and here's how things stand. We're flat on the index at 17,852. We've got the Sensex up about 16 odd points, with the broader markets lackluster. Adani Enterprises is down 1%. Axis Bank along with IndusInd Bank and Kotak are in the red. Bajaj Auto as well is looking a little bit tempered. Ditto when it comes to Titan and Wipro. On the flip side, NTPC gains, Adani Ports and metals like JSW Steel and Tata Steel, they're in the spotlight on the upside. Within the broader universe, Adani continues to remain a bit of a weak spot. So transmission, green, total gas, they're in the red. Something like a Uflex as well has lost out about 2.8% in trade. KEC International is another drag in today's trading session. But let's take it straight then to that mega exclusive with none other than Narayan Murthy, my colleague Anisha Jain, in conversation with the doyen of the Indian IT sector. Anisha.